the unthinkable thought. The question people refuse to ask out loud: is Apple finished? Not as a company. They'll still be around selling iPhones and services. But as a growth stock, as the safe haven investment that everyone assumes will just keep going up forever, as the core holding that every portfolio manager puts their grandmother's retirement savings into without a second thought, is that version of Apple finished? I think it might be. And I'm not the only one who thinks so. I sold 50% of my stake in Apple. Yes, me. The guy who called Apple his favorite business, who praised Tim Cook endlessly, who held through every dip and correction for years. I cut my position in half. Why would I do that? Why would someone who has built a reputation over 6 decades for buying great companies and holding them forever suddenly dump half of one of the greatest companies in the history of American business? People want to believe it's just about taxes. That's what I said publicly, and there's some truth to it. But if you think that's the whole story, you're not paying attention. This is a warning for 2026. A warning that the Apple everyone knows and loves might be fundamentally different, dramatically less valuable, structurally impaired in ways that most investors refuse to see because they're too emotionally attached to the brand. Let me walk you through 17 specific reasons why I believe Apple might be finished as a growth stock, why 2026 could be the year the music stops, and why you need to think very carefully about whether this should still be the largest position in your portfolio. Let me start with the most obvious and most devastating problem: China. Apple relies on China for roughly 20% of their total sales. That's not a small diversification issue. That's a massive structural dependency on a market that's actively turning against them. And the numbers are brutal. Sales in China dropped 20 to 30% in 2024, depending on which quarter you look at and which analyst you believe. But the trend is unmistakable and accelerating. They're getting crushed. Why? Because Huawei is back with a vengeance. After years of being hampered by US sanctions and chip restrictions, they figured out how to make advanced semiconductors domestically. The Mate 60 series phones have 5G capabilities that weren't supposed to be possible given the technology restrictions. And Chinese consumers are buying them in massive numbers, not just because the phones are good, but because nationalism is now a powerful force in purchasing decisions. The Chinese government has been pushing a buy Chinese narrative hard. Using an iPhone in some circles is now seen as unpatriotic, as supporting a company that represents American technological dominance and geopolitical rivalry. The status symbol era of the iPhone in China is ending right before our eyes. 10 years ago, having an iPhone in Beijing or Shanghai was the ultimate flex. It said you were successful, worldly, connected to global culture. Now it says you're out of touch, or worse, that you're not supporting your own country's technological champions. That psychological shift is devastating for a brand that built its pricing power on status and aspiration. When you lose the status game, you lose pricing power. When you lose pricing power, you lose margins. When you lose margins at a company like Apple that's priced for perfection, the stock gets absolutely destroyed. If China falls, and I mean really falls to the point where they're getting 5 or 10% market share instead of 15 or 20, Apple's growth doesn't just slow, it goes negative, decisively negative. You can't lose your second largest market without it showing up in the global numbers. And the stock is priced for growth, not for contraction. The market is not pricing in a scenario where China revenue drops by half. But that scenario is not just possible, it's probable at this point, given the trends we're seeing. Now let's talk about something even more fundamental, something that applies to every large company eventually: the law of large numbers. Apple is worth $3 trillion. Stop and think about what that means. To grow by just 10%, which used to be a routine year for them, they now need to create $300 billion in new value. That's not incremental improvement. That's like creating an entire new Coca-Cola every single year. Do you understand how impossibly difficult that is? At a certain scale, growth becomes mathematically impossible. You run out of customers, you saturate markets, you hit physical limits on how many phones or computers can be sold. Apple has sold billions of devices. They're in every developed market on Earth. They've already captured everyone who's going to buy an iPhone. Where's the $300 billion in new value going to come from? India? They've been talking about India for a decade, and it still represents low single digits of revenue. New product categories? Show me one that's working. Services? We'll get to why that's topped out. This isn't pessimism. This is mathematics. Trees don't grow to the sky, not literally and not metaphorically. Companies can't grow faster than the economy forever. They can't capture more than 100% of a market. At some point, stagnation becomes inevitable. And for Apple, I believe that point is now. They'll still be a great company, but great companies can be terrible investments if you pay too much. And right now, everyone's paying too much because they're pricing in growth that can't possibly materialize at this scale. Let me talk about AI, because this might be the most visible sign that Apple has lost its edge. Microsoft has Copilot integrated into everything. Google has Gemini, which is genuinely impressive and getting better monthly. Meta is pouring billions into AI research. Every major tech company is racing ahead, and Apple has Siri. The same Siri that's been a running joke for over a decade. The same Siri that can't understand simple commands half the time and gives you web search results instead of actual answers. They're late to the AI party, and in technology, being late is often fatal. They finally announced Apple Intelligence, their big AI push, and it's playing catch-up. It doesn't do anything revolutionary. It doesn't have capabilities that competitors don't already have. And parts of it won't even launch until next year because they're still trying to figure out how to make it work properly. That's not what market leaders do. That's what desperate companies scrambling to stay relevant do. Is Apple becoming the Nokia of the AI era? Nokia dominated mobile phones for years. Everyone thought they were invincible. And then the iPhone came along, and they collapsed in what felt like 5 minutes. The smartphone revolution killed Nokia because they were too slow to adapt. The AI revolution might not kill Apple, but it could demote them from premium tier to just another tech company. And just another tech company doesn't deserve a 30 times earnings multiple. Speaking of innovation, when was the last time Apple released something that actually changed the world? The iPhone in 2007, absolutely revolutionary. The iPad in 2010 created an entirely new category. The watch in 2015 turned wearables into a real business. But since then, nothing. Incremental updates, better cameras that most people can't tell apart from the previous generation, faster chips that don't meaningfully change the user experience for 99% of tasks, new colors. That's basically it. The Vision Pro was supposed to be the next big thing. Tim Cook bet years of development and billions of dollars on it, and it's flopping. Sales are weak, reviews are mixed at best. It's heavy, uncomfortable, isolating, socially awkward, and costs $3,500. That's not a mass market product. That's a niche toy for early adopters with money to burn. It might become the next Newton, Apple's famous failure from the 1,990 seconds that everyone forgets about until they need an example of the company screwing up badly. When a company stops innovating, when it shifts from creating new categories to just milking existing ones with incremental improvements, that's a sign that the magic is fading. And the magic is what justified Apple's premium valuation. Without magic, they're just a very good consumer electronics company. And very good consumer electronics companies trade at 15 times earnings, not 30. Let's look at valuation, because this is where the math really falls apart. Apple is trading at around 30 times earnings, 30 times, for a company with effectively zero revenue growth. Think about that disconnect. You pay 30 times earnings for high-growth companies, for businesses that are doubling revenue every few years. You pay 15 times earnings for mature, stable companies that are basically utilities. Apple is being priced like a high-growth startup, but growing like a utility. That multiple has to contract. It's not a question of if, but when. When you can get 5% risk-free from Treasury bills, why would you pay 30 times earnings for a company yielding 3% with significant risks? The math doesn't work. The TINA trade, there is no alternative, is dead. There are alternatives now, plenty of them. And when investors realize they can get better risk-adjusted returns elsewhere, the selling pressure will be immense. The regulatory siege is intensifying from every direction. The Department of Justice has filed a major antitrust lawsuit attacking the core of Apple's business model. The European Union's Digital Markets Act is forcing Apple to allow side-loading, third-party app stores, and alternative payment systems. These regulations aren't theoretical future concerns. They're happening right now, and they attack the walled garden directly. If the App Store monopoly breaks, if developers can bypass Apple's 30% tax and offer apps through alternative stores, if payment processing has to be opened up to competition, services revenue collapses. And services is the profit engine. Services is what's been growing while hardware stagnates. Services is what analysts point to when they justify the valuation. Take that away, and you're left with a commodity hardware business with declining margins. The moat, that durable competitive advantage everyone talks about, is being systematically filled in by regulators. The ecosystem lock-in that kept people trapped buying iPhones even when Android got better is being dismantled piece by piece. And the market hasn't priced this in yet because it's a slow-moving process. But 2026, that's when these regulations really bite. That's when the impact shows up in the financials in a way that can't be ignored or explained away. Now let's talk about my selling, because actions speak louder than words. I praise Apple publicly. I say nice things about Tim Cook and the business model. I call it a great company, but I sold half my stake. Watch what people do, not what they say. Words are cheap. Capital allocation decisions reveal true beliefs. I built a $300 billion cash pile, the largest in Berkshire's history. I'm preparing for something, and I'm using Apple as my ATM to build that cash. Why would I be hoarding cash at these levels if I thought everything was fine? Why would I sell shares in my favorite business if I believed the growth story was intact? The answer is obvious if you're willing to see it. I'm preparing for a crash, or at minimum, a major correction that brings valuations back to reality. And I need cash ready to deploy when the opportunity arrives. Apple is liquid. I can sell billions without moving the market too much, so that's what I'm doing. The fact that I'm selling should tell you everything about what I actually think is coming. The replacement cycle for iPhones has slowed dramatically, and it's not coming back. People used to upgrade every 2 years like clockwork. Now they keep phones for 3 or 4 years. Some people are pushing 5 years. Why? Because phones are good enough. The iPhone 12 is good enough. The iPhone 13 is good enough. The marginal improvement from iPhone 14 to 15 to 16 is so small that only people who need the latest status symbol bother upgrading. That kills unit volume growth. Hardware sales have peaked, not in a temporary way that bounces back next quarter, peaked in a structural, permanent way. The market is saturated. Everyone who wants a smartphone has one. Replacement cycles are lengthening. Average selling prices can only go up so much before you price out customers. This is the reality of a mature hardware business, and that's what Apple is becoming. Services was supposed to be the answer. Recurring revenue, high margins, sticky subscriptions, the annuity model, and it worked for a while. But even services is hitting saturation. How many more subscriptions can Apple sell? Everyone who's going to subscribe to Apple Music already has. Everyone who needs iCloud storage has upgraded to a paid tier. Apple TV Plus is struggling to compete with Netflix and Disney. Apple News Plus and Fitness Plus are niche products with limited appeal. Growth in services is slowing quarter by quarter. It's not the infinite money glitch that bulls pretend it is. And there's a bigger problem looming: subscription fatigue. Consumers are cutting back. They're tired of paying $10 here, $15 there, $20 somewhere else for streaming services and apps and subscriptions that they barely use. When the economy weakens and people tighten budgets, subscriptions are the first thing to get cut. Apple's services growth could reverse quickly in a downturn. Geopolitical risk is the elephant in the room that nobody wants to discuss. Apple's supply chain is still heavily dependent on China despite years of talk about diversification. If China invades Taiwan, if there's a military conflict in the Pacific, if trade relations deteriorate further, Apple stops making iPhones overnight. It's a single point of failure. The entire business model depends on geopolitical stability in a region that's becoming increasingly unstable. Tim Cook made a calculated bet that integrating deeply with China would give Apple access to manufacturing scale and cost efficiency that couldn't be replicated elsewhere. That bet made sense for a long time, but now it's a massive liability. They're stuck. They can't move production fast enough, even if they wanted to. India and Vietnam are nowhere close to having the capacity or expertise. Apple bet the farm on China, and now they're exposed. The brain drain problem is real, and it's accelerating. Jony Ive, the design genius who defined Apple's aesthetic for decades, left. Other key designers and engineers have followed. The soul of Apple, the thing that made it special, is leaving the building. What's left? Operations people. Tim Cook is brilliant at supply chain and operations, but he's not a product visionary. He's not Steve Jobs. Operations guys are great for efficiency and maximizing margins, but they're bad for magic and inspiration. And Apple without magic is just another tech company. When the visionaries leave and the operators take over, companies become conservative, risk-averse, focused on protecting existing businesses rather than creating new ones. That's the path Apple is on. And that path leads to slow decline, not continued dominance. The Google deal, that $20 billion per year that Google pays Apple to be the default search engine, is under serious threat. The DOJ wants to ban these types of payments as part of their antitrust case against Google. And if they succeed, $20 billion of pure profit disappears from Apple's income statement instantly. That's roughly 15% of Apple's total profit. Poof, gone. The market isn't pricing this risk in because people assume it won't happen or will get tied up in courts forever. But what if it does happen? What if 2026 is the year that revenue stream disappears? The stock would drop 20, 30% in a day as analysts scramble to revise their models. This isn't speculation. This is a real regulatory risk with actual dollars on the line. High interest rates are kryptonite for high PE stocks. The math is simple. When you can get 5% risk-free from treasuries, you demand a higher return from risky assets. Apple yielding 3% with multiple risks isn't attractive anymore. The flows reverse. Money leaves stocks and goes into safe bonds. And it starts with the most overvalued stocks first. Apple at 30 times earnings with zero growth is one of the most overvalued stocks in the market. Stock buybacks have been propping up the stock for years, but that engine is running out of gas. Apple spent hundreds of billions buying back shares. It worked while the stock was reasonably valued. But buying back shares at 30 times earnings is value destruction, not value creation. You're paying premium prices to reduce share count. That's bad capital allocation. And when I call something bad capital allocation, you should listen. The buybacks boosted earnings per share artificially without growing the actual business. It's financial engineering, not operational excellence. And eventually the market sees through it. Eventually, people ask why the company is spending so much on buybacks instead of investing in R&D or returning cash to shareholders through dividends. The answer is usually that they have no better ideas for deploying capital. Why 2026 specifically? Because that's when everything converges. That's when the regulatory impacts hit full force. That's when the AI winners will be clearly established, and it will be obvious whether Apple is one of them or whether they missed the wave. That's when China decoupling accelerates as political tensions ratchet higher. That's when the services growth story runs out completely. That's when the safe haven myth dies. 2026 is the cliff. The year when all the problems that people have been explaining away and ignoring become too big to ignore. The year when the narrative breaks. And when the narrative breaks on a stock this widely held, this emotionally beloved, this assumed to be safe, the sell-off will be spectacular. If I'm selling, you should at least be thinking about it seriously. Don't be the last one out. Don't be the person who held on out of loyalty to a brand while your portfolio got cut in half. Take some profits. Rotate into value. Diversify into businesses that are actually growing, that aren't facing existential regulatory threats, that have real pricing power and durable competitive advantages that aren't under assault. Apple was a great run, one of the best investments I ever made. But the party is ending. The music is getting quieter. The lights are coming on. And when I see that happening, I head for the exit, not the bar for another drink. Apple isn't going bankrupt. They'll still be around in 10 years selling phones and computers. But the growth story is finished. They're becoming a dividend stock, a bond proxy, a safe, mature business that pays you 3% annually while inflation eats into your returns. Like IBM, like Cisco after 2000, great companies that were terrible investments because people paid too much at the peak. The stock price will adjust down to match this new reality. Maybe not tomorrow, maybe not next quarter, but 2026, I think that's when it happens. That's when the music stops completely. And you want to have your exit strategy ready before that happens, not after. Be prepared. Protect your wealth. Don't let emotional attachment to a brand destroy your financial future. Let me dig deeper into the China situation because the numbers are even worse than they appear on the surface. It's not just that sales are down 20 to 30%. It's that they're down among the most valuable customers. The premium tier, the people buying pro models and maxing out storage, those customers are abandoning Apple fastest. They're the ones most susceptible to nationalist sentiment because they're sophisticated consumers who pay attention to geopolitics. When local alternatives become acceptable or even superior, when Huawei is offering phones with features that match or exceed iPhone, The rational decision for a patriotic Chinese consumer is obvious. And China has 1 billion people who consider themselves patriotic. That's the addressable market shrinking in real time. The psychology of status symbols is fragile. Once the narrative flips, once owning an iPhone goes from aspirational to embarrassing, you can't reverse it with marketing or features. It's a cultural shift, and Apple is on the wrong side of it in the world's largest market. They're fighting against nationalism and government policy and cultural momentum. That's not a fight you win with a better camera system. The law of large numbers problem compounds with every quarter. Think about it this way. When Apple was a $100 billion company, growing 10% meant finding $10 billion in new value. Challenging but doable. At $500 billion, it meant finding $50 billion. Hard, but they managed. At $3 trillion, it means finding $300 billion. Where? Show me the specific products and markets that generate that. Because I've looked, and they don't exist. Every analyst presentation waves hands about services and wearables and new categories. But services growth is slowing. Wearables are a $10 billion rounding error on a $3 trillion valuation. New categories don't exist except in Tim Cook's carefully scripted presentations. The math doesn't work. And when the math doesn't work at a company priced for premium growth, the reversion to reality is painful and swift. The AI lag is more serious than people want to admit because it represents a shift in what premium means. For the past 15 years, premium meant Apple. Beautiful hardware, elegant software, integration that just works. But AI is becoming the new definition of premium. The companies with the best AI will command the best prices and the most loyal customers. And Apple is behind, meaningfully behind. You can see it in the product launches. Microsoft is embedding AI that actually works into Office and Windows. Google is making Gemini genuinely useful for search and productivity. Apple is promising features that'll come later, maybe, if they can figure out how to make them work without completely embarrassing themselves. That's not market leadership. That's panic-driven catch-up. The innovation drought connects directly to the brain drain. When Jony Ive left, he took something intangible but critical with him. The design language, the aesthetic philosophy, the willingness to take risks on unproven concepts. What's left is a committee-driven organization that's terrified of failing publicly. They launch products years late because they've been focus grouped and reviewed and refined to within an inch of their life. That kills innovation. True innovation requires risk, failure, iteration. Apple under Cook has become risk-averse. Look at what they've launched in the past 5 years. A credit card, slightly better phones, expensive headphones, a VR headset that nobody wants. These aren't world-changing products. These are line extensions and Me Too products in categories other companies pioneered. Where's the boldness? Where's the willingness to cannibalize their own products to build something better? It doesn't exist anymore. The valuation disconnect becomes more absurd the longer you stare at it. They're trading at 30 times earnings with flat revenue. Let me say that again because it bears repeating. 30 times earnings, zero revenue growth. That doesn't happen in rational markets. It happens in bubbles. It happens when people are buying based on narrative and brand love rather than on financial analysis. And bubbles always pop, always. The only question is when. I can sit here with $300 billion in cash earning 5% and wait for Apple to come back to earth. Or I can own it at 30 times earnings and pray that somehow they find miraculous growth while fighting regulators, losing China, missing the AI wave, and dealing with saturated markets. That's not a hard decision for me. Patience wins, discipline wins, and right now, Discipline means reducing exposure to overvalued assets, even when they're high-quality businesses. The regulatory assault is just beginning. The DOJ lawsuit will take years to resolve. The EU regulations will get stricter, not looser. China might force divestitures or data localization that breaks the integrated ecosystem. India is already pushing for local manufacturing and local data storage. Every major market is moving toward more regulation, more nationalist policies, more barriers to Apple's integrated global approach. They built an empire on globalization and regulatory tolerance. Both of those are ending. And when I sold, I sent a signal louder than any shareholder letter could. The world's most famous investor, the guy known for holding forever, selling his favorite position. That's a five-alarm fire. That's a warning siren. But most people aren't listening because they don't want to hear it. They love their iPhones. They love the brand. They've made money owning the stock. So they explain it away. They rationalize. They assume I'm wrong or too old or too conservative. That's fine. When the price is half of today's level in a few years, they'll wish they'd paid attention. The replacement cycle dynamics are fascinating from an economic perspective because they reveal how commoditized phones have become. When phones were rapidly improving every year, when the iPhone 4 to 5 to 6 represented massive leaps in capability, people had rational reasons to upgrade. The new phone could do things the old one couldn't. But now, the iPhone 12 does everything 99% of people need. The iPhone 13, 14, 15, 16, they're incrementally better at the margins. Slightly faster, slightly better battery, slightly improved cameras that you can't notice unless you're a photography obsessive. Those aren't compelling upgrade drivers for normal people. So people keep their phones longer. And when they finally do upgrade, they're often upgrading to last year's model at a discount rather than the latest release. That kills revenue growth and pricing power simultaneously. It's the pattern you see in mature markets. It's what happened to PCs in the 2010 seconds. It's what happened to cars. And now it's happening to phones. Apple is transitioning from a growth hardware company to a mature replacement cycle business, but they're still priced like the former rather than the latter. The services saturation problem deserves more attention than it gets. Apple Music competes with Spotify and has for years. They haven't won that war. They're number 2 and not catching up. iCloud storage hits natural limits based on how much people actually need. Most people get by with the free tier or the cheapest paid option. Apple TV Plus is spending billions on content and still has minimal market share compared to Netflix, Disney Plus, Amazon Prime. These aren't winner-take-all businesses where Apple can leverage their ecosystem into dominance. These are competitive markets where they're just another player. The myth of infinite services growth needs to die. It's based on the assumption that Apple can keep adding successful subscription businesses and keep raising prices on existing ones. But consumers are pushing back. Subscription fatigue is real. People are canceling services they don't use regularly. They're price sensitive. They're looking for bundles and deals. The days of easy double-digit services growth are over. We're headed for low single-digit growth at best, and quite possibly negative growth in a recession when consumers cut discretionary spending. Geopolitical risk is a scenario nobody wants to think about because it's genuinely scary. But if you're investing for the long term, you have to consider tail risks, even uncomfortable ones. What happens if there's a military conflict between the US and China over Taiwan? What happens if China decides to nationalize foreign assets or impose restrictions on foreign companies? What happens if supply chains completely break down? Apple goes from the most valuable company in the world to a company that can't manufacture its primary product. The stock would crater 70, 80% overnight, maybe more. That's an extreme scenario, sure. Maybe the probability is low, but the probability isn't zero, and it's increasing, not decreasing, as U.S.-China relations deteriorate. When you're paying 30 times earnings for a company with that level of geopolitical concentration risk, you're not being compensated for the tail risk you're taking. You should be getting a huge risk premium, a discount to intrinsic value. Instead, you're paying a premium. That's backwards. The Vision Pro failure is instructive because it shows what happens when Apple tries to create a new category post-Steve Jobs. They throw infinite resources at it. They hire the best engineers. They spend years in development. They launch with huge fanfare. And then it flops because they fundamentally misunderstand what people want. People don't want to strap heavy, expensive goggles to their faces and isolate themselves from the world. That's not solving a real problem. That's solving an imaginary problem that exists in a boardroom somewhere, but not in actual human life. Steve Jobs had a genius for understanding human desires before people could articulate them themselves. He knew people wanted a phone that was also an internet device and an iPod before anyone asked for it. Tim Cook has no such instinct. He's brilliant at operations, but he doesn't understand desire. And without understanding desire, you can't create new categories. You can only optimize existing ones. That's fine for a mature company, but it's not fine for a company priced for innovation and growth. The Google payment issue is a ticking time bomb with a very clear deadline. The DOJ case is moving forward. The judge has already ruled that Google is a monopoly. The remedy phase is coming, and eliminating these exclusive payment arrangements to default search engines is one of the most obvious and likely outcomes. That's not speculation about what might happen in some distant future. That's a realistic scenario for 2025 or 2026. $20 billion of pure profit going away. And here's the thing. Apple can't replace that revenue easily. They can't just create their own search engine and make as much money. They can't increase services prices enough to offset it without triggering customer backlash. It's just gone. The earnings power of the business decreases by 15% overnight if that happens. And the stock is priced as though earnings will grow, not shrink by 15%. The repricing would be vicious. I keep coming back to the interest rate environment because it's so fundamental and so many investors ignore it. The entire bull market from 2010 to 2021 was built on zero interest rates. When money is free, when bonds yield nothing, investors have no choice but to buy stocks. They have to reach for return. That forced buying pushed valuations to absurd levels. 30 times earnings became normal. 40, 50 times earnings for growth stocks became acceptable. The whole market inflated like a balloon. Now rates are 5% and likely to stay there for years. The balloon is deflating, not popping necessarily, but deflating. Money is flowing from stocks to bonds. The forced buying is over. And when that reverses, the highest valuation stocks fall hardest and fastest. Apple at 30 times earnings with mature growth is one of the most obvious candidates for a major repricing, not because the business is bad, but because the valuation doesn't make sense in a 5% rate environment. The stock could easily fall to 20 times earnings, maybe 15, and still be fairly valued. That's a 33 to 50% decline from current levels. Can your portfolio handle that? Because mine can't, which is why I sold. The buyback situation is offensive to me as someone who cares deeply about capital allocation. Buying back stock makes sense when your stock is undervalued or at least fairly valued. You're returning capital to shareholders in a tax-efficient way, and you're increasing their ownership at a good price. But buying back stock at 30 times earnings is like me buying Berkshire stock at 3 times book value. It destroys shareholder wealth. You're overpaying massively for shares that should be trading at half the current price. The fact that Apple is spending tens of billions annually on buybacks at these prices tells me they have no better ideas for the capital. They're not finding investment opportunities that would generate adequate returns. They're not seeing areas to expand the business profitably. They're just engineering the per-share metrics to make earnings growth look better than it is. That's financial gimmickry, not value creation. And when companies resort to financial gimmickry, it's usually because the underlying business is stalling. When I look ahead to 2026, I see all these problems converging simultaneously. The China situation continues deteriorating. The regulatory pressures intensify. Services growth slows to a crawl or goes negative. The Google payment gets blocked. The AI winners and losers become obvious, and Apple isn't in the winner's circle. The replacement cycle stays extended. The Vision Pro continues failing. The market realizes the growth story is over. The valuation multiple compresses. The stock falls 30, 40, 50%. That's not a prediction, it's a scenario. But it's a scenario with high enough probability that I'm positioning for it. I'm reducing risk, I'm raising cash, I'm preparing to buy real value when it appears. And selling Apple at these prices to build that war chest makes perfect sense to me. The party is ending. The lights are coming on. The music is slowing down. And when I see that, I leave. I don't stay for one last drink. I don't hope the party goes on longer. I walk out the door while I can still walk straight. That's what selling Apple is. It's leaving before the crash. It's taking profits before they turn into losses. It's protecting capital so I can deploy it intelligently later. That's not pessimism. That's not being bearish on America or on technology. That's being realistic about valuations and risks and being disciplined enough to act on that analysis even when it's uncomfortable. Apple will survive. They'll sell iPhones and Macs and iPads for decades. But surviving isn't the same as thriving. And thriving isn't the same as being a good investment at today's prices. The growth chapter is closing. The mature, slow growth dividend chapter is opening. And if you're still hoping for growth, you're going to be disappointed. Better to accept reality now, take your profits, and redeploy into opportunities that actually have growth ahead of them rather than behind them.